Hello guys, today some trouble with the internet, so I feel sorry to not come online on the time. Right now, without wasting time, I will begin with my course. What I covered till now, I covered overview of derivatives in last two classes, two or three classes. No, last two classes I can say. Overview of derivatives, market participants, and option terminology and future terminology also, and somewhat for detailed information of options. My agenda for today is I will try to cover moneyness of options, option premiums, component of option premium, and somewhat about option Greeks. Not all, but I want to like touch off option Greeks. So let's focus. I think my audio is clear to you. There is not an issue. If an issue, then comment on that. Okay, so let's go. This is my last class, last to last. If anyone missed it live, then I uploaded my channel. If not subscribed, then subscribe and watch this, which I covered in last class and last classes on that was Saturday. So here we left. I discussed strike price or exercise price. Now go for the in the money, ATM, OTM, intrinsic value, time value, open interest, lots of things. And the remaining we cover fundamental parameter, which option price depends, that is spot price of underlying, strike price, volatility, time to expiration, interest rate. Then go for the, in case you have a time, then go for the delta, vega, theta, rho, the first order Greeks and second order Greeks. Too much time consuming, so very fast. Let's go. Not too much. If you have any query, ask. I will definitely answer. Fine. I think voice is clear. After I check the no comments. So clear. What is in the money options and how we differentiate with in the money ATM, OTM? Let's take an example, then understand. Okay, let's open the notepad. Yeah. So for today class, in the money means if we buy any of the option and upfront we are getting a money. These are the options are in the money. Like we buy the option and just sell the option and get money. How we I will define. But that type of options are in the money options. So let first discuss in the money options. ITM options. If market is trading at 15,000 future price and you bought a call, you bought a put a year. Is it possible? No. Giving you 200 points, 200 rupees. That is possible to buy and you can less than 200 rupees? No. That's the reason this is called in the money option. Go for the put. Just a minute. Yep. If we go for the put of 15,500, but market is trading at 15,000. So estimate some error. Okay, not an issue. Carry on. That means you are buying a put of 15,500 with rupees more than 500 at least you will buy, because seller lose upfront 500 rupees if we buy a put if you buy a put are able to buy a put less than 500. If you get a price of 450 at market, without thinking you buy a put when market is trading at 15,000, the 15,500 put is any point of time, just 5 minutes before the expiry. This put is trading at 450, 460, immediately buy, because the value should 500 at minimum or more than that. That's the main thing. Just a minute. Okay, that's the reason we are calling these type of options are in the money. In the money means without any movement, you are getting a money that is in the money. Or theoretically, we can understand if in call prospect above than, yeah, less than spot price. Okay, in a put, buy less than, because you are buying, you are betting market will expire more than this. If market is trading and at the time you are betting, you know this is the point which I get. Market is trading at 15,000, or you are betting market will trade more than 14,800. This is a trading. This is a fact. This is not a bet. So minimum this more than spot price, any of strike, yeah, all strikes are ITM in a put. Guys, this formula is applicable to all the indexes, future, all everywhere in options, currency, commodities, everywhere, bank nifty, nifty, fin nifty, any of the call option less than the spot price is in the money, because you are taking a initially money from the seller without movement of a market. The put side, any strike, all the strike which more than the spot price, because you are trying to sell, are in the money. I think in the money concept is clear. If there is issue, then ask me and move forward. I think not an issue. Let's go for the ATM. ATM options. When you buy any option and you are unable to get any of profit, that strike is ATM. If market is trading at 15,000 future price, you are buying up 15,000 call, or we can say put. If you sell, market will expire because you want more than or less than this amount. Then you getting money because you in call side you are making a bet market will go up more than you bought the strike price. Your strike price is 15,000. Market is not more than the 15,000. And a put side, you are right to buy the right to sell if market goes down less than by 15,000. But market is on 15,000. No cops, no call holder and put holder, no one getting a money. That's the reason this is ATM. Add the money strike. There's no money. Now come to the just a minute. That is not means that not have a yes. At the 3:30 Thursday on expiry day, the this will expire by zero. But before 3:30, there is some probability the ATM option if the future price move up by single point, then in a for call case that will be in the money ATM OTM. I will check any response. Uh, I will ask again if market is trading at 15,000 and you are holding a 15,000 call. If future increase by 1 point, yeah, 1 rupees, are you getting any of amount in a call? By which amount the call will be in the money? You will get if market will expire 15,000 1 rupees for 15,000 call holder will get initially 1 rupees by multiply by 75. You will get 75 rupees if you nullify the premium, whatever you get. Now, if 15,000 future come down by 1 2 rupees, you will get by the put. So for a put and a strike price, all put, all the strike which are more than the spot price, just like this. If future price become 14,900 for a put, that will be a in the money. Or for a call, 15,000 call will be a OTM. But ATM, when you are not getting any of money, you will pay only and only the probability when you are getting by what time you will buy the ATM option before the expiry, not on expiry. Yeah, we can say on not 329 or 330. You will not buy because this will be ultimately going to zero. 5 days before, 10 days before, you are expecting market will obviously market will go down or up by any of point. So for a rule basis, when strike price अदर मेथड यूज करूं फॉर ओटीएम के लिए which strike neither in the money nor ATM, all strike are OTM. Check, is it in the money or ATM? Nothing else, then all the strike are OTM. Simple. First time. Second one, my voice getting properly. There is no trouble. In case it's in between, then tell me. Chen. But, but theoretically, if you guys any of the yes, here we go. So intrinsic value, which is which is actual value, which should be if market is static, should be the price. Option previous should be this is intrinsic value. But time value have a two. What was market today, tomorrow? Yesterday, sorry. What was it? Yes, I will check. A strike of 14,500. If we buy, yeah, if we take a bet, the market will expire up by the 14,500. I am taking a bet, but you are not taking a bet because amount which you can get initially without movement of future. But what should be the premium minimum? Yeah, what should without any movement of future. So let's check what is the price. All is LTP. Sorry, we are giving for that's the reason. Okay, now you will. So this was typo error.